So outside of Alberta, existing fundamentals look solid. However, there is clearly a level of uncertainty hovering over the entire market that exceeds anything that we've seen in recent years. The market faces very real economic headwinds, and I'm not trying to downplay them, especially the potential contagion of weak resource pricing on the broader economy. That is a very real risk. But the true measure of the impact of low resource pricing is not just how much it has fallen, but how long it will last. And that remains a story which is yet to unfold. I also think at times like this, it is very important that we keep things in context. And I think it is instructive to keep in mind the underlying strength of the industry in Canada. Consider the following. The Canadian REIT industry didn't even exist prior to 1992 and has since evolved into approximately 100 entities, bringing with it public market discipline and generally excellent management. Payout ratios are declining as REITs move to a more conservative total return model and now average approximately 79% versus 97% in 2008. Some REITs have moved out along the risk curve and have ramped up their development activities, but only because they have the scale to allow for it. Most are allocating less than 10% of their balance sheets to development, and in the unlikely event that a development were to completely blow up, their dividends are covered. Canadian pension funds are amongst the most sophisticated capital in the world, and allocations to real estate have increased every year and continue to move up. Pension funds, either directly or indirectly, are responsible for the largest developments in the country, and they have the ability to weather market volatility much better than the highly levered private entities of the past. Industry leverage is conservative. Loan to fair market value ratios for REITs average approximately 50%. LTV ratios for private buyers are well within historic norms, and there are virtually no players of any consequence who are levered up to their eyeballs. For the most part, the addition of new supply is disciplined with stringent pre-leasing requirements across the board. Yes, we do have pockets of concern, notably in the office sector, but it is nothing like what we have seen in the past. The supply-demand imbalance between quality assets and capital looking for a home is growing wider. The competition for a finite supply of core real estate is unlikely to change anytime soon and will probably only intensify. And in markets like Vancouver and Toronto, land constraints provide upward pressure on everything. Now, when you put all of that together, the result is an incredibly strong foundation that allows our industry to absorb external shocks like a sudden plunge in oil prices better than at any other time. It also means that a great degree of the volatility that we used to see in real estate has been permanently removed. Now, it certainly doesn't mean that real estate is no longer cyclical, nor am I being dismissive of some of the real economic challenges that we face. But the wild gyrations in rents and prices that we have seen in the past are likely over. And it means that we have better resilience as an industry than ever before. To put that another way, a healthy 25-year-old with the flu is much less vulnerable than an 85-year-old with a cold. And for the best evidence of this, think back to the last recession. An unprecedented global financial catastrophe, and relatively speaking, Canada skated through it. We had a period of extreme illiquidity, but there was virtually no distress selling, no blood on the streets.